Welcome to Financial Insights in Minutes, where we provide time-saving summaries of important economic topics.
We're here to break down today's top financial discussions, helping you stay informed in a fast-paced world.
Today's discussions cover crucial insights into the US dollar's future and the impact of rising geopolitical tensions.
We'll explore worries about employment and consumer behavior, as well as expectations for gold prices amid Fed shifts.
Stay tuned as we summarize expert analysis that could impact your financial strategies.
Now let's dive into our first video of the day.
First, Arthur Laffer warns about the US dollar losing its dominance and the risks of rising alternatives like Bitcoin and gold. Next, Jeff Snyder exposes the concerning link between declining consumer credit and rising unemployment rates. Philip Pilkington analyzes the dire implications of the Israel-Iran conflict on global oil supplies. Then, Mike from Mott Capital clarifies the Bank of Japan's cautious approach amidst market turmoil. Finally, Levi Gunter predicts a pivotal shift from the Fed that could drive gold prices significantly higher. Welcome back to Kitco News. Today we're exploring a pressing topic. Is the US dollar becoming an unhinged paper currency? With us is the renowned Art Laffer.
Laffer, the father of supply-side economics, is here to share his insights on the US dollar's current state and its implications for the global economy.
So, Art Laffer's main assertion revolves around the deteriorating state of the US dollar. What's the crux of his argument?
Laffer warns that the dollar's attractiveness is plummeting, pushing countries to seek alternatives like Bitcoin and gold. His concern is that this trend can lead to a significant loss of dollar dominance.
Laffer also pointed out the current economic turmoil. What's the lowdown on that?
The U.S. economy is witnessing troubling signs, including skyrocketing credit card debt at $1.14 trillion and rising recession fears, showing a clear disconnect in market signals.
As countries shift their trading currencies, what does this mean for the dollar?
It's potentially dire. Laffer pointed out that countries are increasingly ditching the dollar for local currencies in trade, as evidenced by a drop in dollar reserves held by central banks to 58.4%.
What remedy does Laffer propose for this economic unraveling?
He advocates for a complete overhaul of economic policies, emphasizing the need for free trade, maintaining sound currency, and strict control of government spending.
So, what's the crystal ball say on the future of the US dollar?
Laffer predicts we might see a shift where alternatives like Bitcoin or gold rise, possibly leading to the dollar being replaced in the global economy.
What might bring about these shifts? Any hope on the horizon?
It's all about political will. If there's a shift back to the laissez-faire policies seen in past administrations, we might witness dollar revival.
To wrap it up, what's the main takeaway?
The overarching message is clear. Without sound economic policies and faith in the dollar, its dominance could vanish. Laffer presses for a return to real growth driven by effective governance.
Welcome to Eurodollar University. Today, we'll uncover the significant connection between consumer behavior and unemployment rates. Buckle up as we dive into some intricate economic signals.
Absolutely. Jeff Snyder takes a closer look at credit card usage and its alarming ties to rising unemployment. His sharp insights make for a compelling discussion.
What's the core issue at hand?
The central thesis is that declining consumer credit usage reveals deeper concerns about job security, foreshadowing a potential rise in unemployment.
Let's dissect the first key point: credit card usage.
There was a notable decline in credit card balances in June, indicating consumers are becoming cautious about their spending.
Interesting. How does this relate to unemployment?
Exactly. When consumers tighten their belts, it's often a precursor to rising unemployment. It's a cyclical pattern.
And what about construction spending?
The report shows slumping non-residential construction spending, hinting businesses are becoming less optimistic about the economy.
Now, what's the situation in the airline sector?
We're seeing airlines like Southwest and Delta struggling to fill planes, which reflects broader shifts in consumer spending habits.
What's the prediction regarding unemployment?
We could see rising unemployment rates as consumer credit signals are suggesting a downturn is inevitable.
Any other predictions from the analysis?
Definitely. Ongoing declines in consumer credit suggest significant economic challenges may be just around the corner.
To wrap this up, what should we take away?
It's crucial to monitor consumer credit trends closely. If the current patterns continue, the labor market may not be far behind in facing serious challenges.
So, final thoughts on the economic outlook.
Absolutely. Stay vigilant for any economic signs emerging from consumer behaviors and employment figures that can hint at an impending recession.
Welcome back to David Lynn's channel. Today, we're diving into the rising tensions in the Middle East and the looming global oil crisis that could follow. Joining us is Philip Pilkington, co-host of the Multipolarity podcast and a visiting fellow at the MCC. Let's set sail on this crucial discussion.
Absolutely. Philip's insights into geopolitical risks are invaluable, especially with the recent events in Iran and Israel shaping the future of oil markets. Keep your life jackets on, folks.
So, what's the crucial thesis from Philip's analysis? What danger lurks beneath the surface?
The core thesis suggests that should conflict erupt in the Middle East, particularly between Israel and Iran, it might lead to a blockade of the Strait of Hormuz. This blockade could cause severe global oil shortages, reminiscent of the 1973 oil embargo.
Let's break down those key points. First up, geopolitical risks. What's the situation?
Investor surveys indicate that fears surrounding geopolitical tensions are rising, potentially more so than in any recent year. This seems especially pertinent regarding the Middle East.
And about that potential blockade of oil, what should we watch for?
Should a war commence, Iran's capacity to blockade the Strait of Hormuz could cause oil prices to soar, creating shortages in international markets. This is a concern that traders are beginning to monitor closely.
Now shifting to military strategies issued by our guest, what can we expect?
Iran may retaliate with missile strikes, which raises the stakes considerably. Meanwhile, Israel's response would likely involve advanced airstrikes, but there are limits given their existing engagements.
What about predictions for these geopolitical tensions?
The expectation is for further military confrontations, which could lead to a significant spike in oil prices. Traders should definitely brace for turbulent waters ahead.
And let's not forget neighboring players. What role could Turkey play?
If regional conflict escalates, Turkey might feel pressured to intervene, which could lead to significant economic sanctions and further geopolitical instability.
So what's the bottom line as we navigate these troubled waters?
The overall takeaway here is that escalating tensions in the Middle East could significantly disrupt global oil markets. All eyes should be on these developments. Remember, Geopolitical Watch is a full-time job.
Welcome to Mott Capital's Market Chronicles. Today we dive into, is the Bank of Japan really capitulating to market pressures? It's been a hot topic recently, so grab your life jackets as we navigate these turbulent waters.
Right, and this is a must-watch for anyone keen on understanding the nuances of global currency dynamics. The depth Mike goes into about the BOJ's recent statements is particularly enlightening. Let's break it down.
So what's the core thesis from Mike's deep dive?
Essentially, the narrative that the BOJ has capitulated to markets is misleading. They are emphasizing a cautious approach in response to current economic indicators rather than yielding to market pressures.
Let's go deeper. What can you tell us about the yen's recent moves?
The yen experienced a temporary rebound, which is purely technical. The BOJ is watching for stability, particularly concerning import prices and inflation, before making any moves.
What's the connection between the Fed and the BOJ?
As the Fed raises rates, the implications for the yen become critical. If U.S. rates rise, that typically weakens the yen further, given Japan's reliance on imports priced in dollars.
And what should we watch for with market indicators?
It's crucial to monitor Japanese stocks, as they are a reflection of economic health. If the Nikkei struggles, it could forecast trouble for U.S. markets too.
Got any future forecasts from this analysis?
Absolutely. The BOJ will likely adjust rates based on economic cues, while any significant turmoil in global markets could prompt them to recalibrate their approach.
What are Mike's predictions moving forward?
Mike predicts that the BOJ will closely monitor corporate performance. Should profits dip or economic signals worsen, we could see rates shift sooner than expected.
And what about market volatility?
With rising unpredictability, any shocks in international markets could destabilize the yen, prompting emergency measures from the BOJ.
To wrap things up, What are the key takeaways?
In essence, the BOJ's cautious stance isn't a capitulation, it's a strategic assessment of their economic environment. Keeping an eye on the global landscape is crucial as the situation unfolds.
Any last thoughts on why we should stay alert?
Absolutely. The interconnectedness of global markets means shifts in places like Japan can ripple outwards. Staying informed helps us navigate what's ahead.
Welcome back to David Lynn's channel. Today we're exploring a hot topic, the upcoming pivotal shift from the Federal Reserve and its impact on gold prices. Joining us is Levi Gunter, the savvy sales and marketing manager at One Gold, who's here to illuminate the path forward in this volatile market.
Thanks for having me. The recent turbulence in markets makes this discussion timely. We're diving deep into gold and silver, so let's get straight to the facts.
What's the crux of Levi's argument regarding gold and the Fed?
The main thesis indicates a significant Fed pivot expected in September will drive gold prices higher. Despite recent sell-offs, Levi believes that the long-term outlook for gold remains bullish.
Can you break down the recent market volatility?
Absolutely. Gold and silver saw significant drops, with silver down approximately 7%. This sell-off reflects a broader market trend during economic downturns.
How do safe haven assets like gold behave during sell-offs?
It's a tricky situation. Even though gold is considered a safe haven, it often sees declines at the initial stages of a market correction.
What's the role of central banks in this gold narrative?
Central banks are ramping up their gold purchases, highlighting their trust in the asset, even as the Fed pivots on its interest rate stance.
What about the effect of geopolitics?
Geopolitical tensions are a significant driver. They ensure that despite short-term price dips, gold remains appealing for long-term investment.
And what's the prediction for gold prices moving forward?
Looking ahead, gold could see an uptick of about 18% by year-end, putting it around $2,450.
What are Levi's forecasts for the future of gold?
Levi predicts that the economic backdrop and anticipated Fed cuts will likely lead to a robust rise in gold prices.
What about central bank activity?
Expect increased central bank purchases as more institutions shift to gold amid economic uncertainties.
To wrap it all up, what should viewers take away from this discussion?
Gold's position as a stable investment amidst uncertainty underscores its value, especially with predicted price increases and ongoing geopolitical challenges. It's certainly a market worth keeping an eye on.
In summary, today's discussions highlighted critical economic concerns, starting with the US dollar.
Laffer warns about its declining status against alternatives, while Snyder correlates declining credit trends with potential unemployment.
Pilkington reminds us of the risks posed by geopolitical tensions impacting oil supply.
Mike refuted the narrative of the BOJ capitulating to market pressures, emphasizing a cautious strategy.
Finally, Gunter predicted that a Fed pivot could lead to a resurgence in gold prices.
Despite the differing views, all guests agree that monitoring these economic signals will be vital moving forward.
Thanks for watching Financial Insights in Minutes for August 9th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.